So it's important when you are doing merchandising transactions to recognize whether you are the buyer of the goods or the seller of the goods. Merchandisers do both things. They purchase or buy goods from suppliers, and they sell goods or merchandise to customers. So in this little video, I just want to go over how the transactions work when you are the seller. So when the business that you are recording transaction for is the seller of the merchandise. So whenever we sell, we have to record two different transactions. The first is the revenue transaction, which recognizes the amount of money we receive from the customer. And so that's going to be at the, sometimes people call that the retail price, or the amount that we're selling it to the customer at. And that will usually involve the debit of cash and the credit of something like sales revenue. Sometimes it involves the debit of accounts receivable and the credit of sales revenue. So that will be the revenue side of the revenue portion of the transaction. The second part is the cost portion of the transaction. We have to record the cost of the goods we're selling. And so that will involve a debit to cost of goods sold and a credit to the merchandise inventory account. So the one transaction records the amount we receive from the customer as revenue and is either cash or an increase to accounts receivable. The other transaction involves the amount of the cost of the goods we're selling and the reducing of the merchandise inventory, because we no longer have the inventory because we sold it to the customer. So here's a couple of examples. The first is if we sell something without any discounts. So again, the simplest sort of form. So we sell $1,000 of merchandise on credit. The merchandise had a cost basis, meaning it cost us $300. So the first thing we'll do is enter the revenue entry, where we will debit accounts receivable, and that's because it said we sold it on credit, and credit sales for the $1,000 price that we sold it to the customer at. And then the second entry we have to record is the cost entry, where we record the cost of goods sold and the merchandise inventory going down. So we debit cost of goods sold because it's an expense, and we credit merchandise inventory, it's an asset, and that we do at the cost. You could say that our gross profit on this transaction is the difference between the revenue of 1,000 and the expense of cost of goods sold of 300. So we made $700 gross profit on the transaction. So what do we do if we have sales discounts? So if we are giving a discount to our customer. So again, we have to do our transaction. So it'll look the exact same as if we sold it cash, except instead of accounts receivable, instead of cash on the debit side, we're gonna debit accounts receivable. So again, that first transaction, we debit accounts receivable, credit sales for the full $1,000. And then we debit cost of goods sold and credit merchandise inventory for our cost of $300. But since it has a discount, if our purchaser or if our buyer pays within the discount period, they're going to get a discount. So for that, we're going to show the amount of cash we actually receive. And we're going to figure out the amount of discount, which is 2% of the $1,000 or $20. And so then we'll debit cash of $980 and sales discounts of $20. And then we'll credit the entire accounts receivable of 1,000. If the buyer pays after the discount period, they don't get a discount. So then we just debit cash and credit accounts receivable for the full $1,000. Also, as the seller, we have to deal with returns and allowances. Sometimes our customer will return merchandise to us. So we will debit our sales returns and allowances, $15, and credit cash. If the returned goods are not defective, meaning if we can just put them back on the shelf or whatever and sell them again, then we will also debit merchandise inventory, show our inventory going up, and credit our cost of goods sold by the full amount. If they are defective, then we would debit merchandise inventory I feel like it's not giving us the full information here. So, but we would debit, the amount of the goods that are still usable to us. So we would add those back into merchandise inventory, and the rest, the amount that's defective, we would debit to an account called lost for defective merchandise. And then we would credit the entire cost of goods sold. So again, it has to do with whether or not we can resell those goods or not. And then one last thing, just as we looked at when we were the buyer or purchaser, when we're the seller, we may sometimes grant allowances to our buyers. And so this says that $40 of the merchandise sold in November was defective, but the buyer decides to keep it because Zmart offers a $10 price reduction. So whenever we offer or grant an allowance to our customer, we're just going to debit sales returns and allowances and credit cash because we're actually sending cash back to that customer. I hope that helps a little. Again, really, it's fundamental to figure out, am I the buyer or the seller? And then it's quite a bit easier to apply all of these rules.